I recently had the opportunity to meet with the CEO of Express, Tim Baxter, and he openly talked about Express being one of the Wall Street Bets meme stocks. GameStop was the most famous, the one that ran from 20 to 400, got some congressional attention, but there's several others, and Express was one of them. He had a really great, it was great talking about it first, because oftentimes CEOs of publicly traded companies won't discuss stock price activity, especially if it's out of the ordinary, if it's unusual. So he openly talked about that. December of 2020, the stock was under $1. They're wondering, are they even going to be listed anymore in a major exchange? And then a couple weeks later, the volume rolled in, stock spiked to 11, and since then it's come down to $3 or $4 a share. The spike to 11 was the highest it's been in many years, and it wasn't real, as they say. It certainly was very real for people who experienced it, but it wasn't driven by underlying fundamentals. He said that one of the biggest impacts was a big base of their institutional shareholders that forever would say, hey, we're stand by this company, we're going to be a part of it for good. When it spiked to 10 or 11, they sold. 80% of their big holders were like, we're out. And he talked about the importance of how do you manage your stock price effectively, and has a lot of lessons for founders of startups, employees that are getting stock options at a startup, as well as people that are investing in startups. There is a stock price. Anytime they say a company raised $1 million at a $10 million valuation, there's a price per share behind the scenes based on how many shares are out there. Sometimes these valuations, maybe get a favorable spike to those that own shares, kind of like the meme stock. Maybe it's not based on anything real. You think about, if you have these artificial spikes in the stock price, think about a situation where 80% of your shareholder base, your big investors, your key employees are like, I'm out, I'm taking the money and running. Where does that leave the company? It's like, well, it was never going to get that high. It was fake. If you're investing in it, well, how is the company managing its stock price? Are they just trying to drive up the stock price for it, at any cost possible, even if it's detached from what may be an appropriate or real stock price? Well, that might change the investment thesis a little bit. So I think if you're a founder, as you're growing your business and raising capital, how do you manage that stock price? You certainly don't want to leave money on the table or give too much away, but you want to be real about it. If you're an employee with stock options, how is your employer managing that stock price? Will there be opportunities for you to exit at a favorable price and a sustainable price? Or will that one opportunity where it spikes kind of artificially, will that be something that's missed and will never come back again? And if you're an investor, how is the company managing that stock price? Because ultimately that's the big driver of value. You have a certain number of shares or options, and everyone hopes to one day be able to convert those into cash, something they can pay some bills on. And if a company is not effectively managing their stock price, that can make it very difficult for investors, for founders to generate sustainable returns over the long haul.